In venture capital, every funding round is a collective effort, with multiple investors coming together to finance a startup. But within that group, not all investors play the same role. Some take the lead, negotiating terms, conducting due diligence, and setting the valuation. Others follow, investing under the terms established by the lead. Understanding the difference between lead investors and followers is critical for both founders seeking capital and VCs looking to structure their investments effectively. Each role comes with different responsibilities, risks, and levels of influence over the startup's future. The lead investor plays a pivotal role in venture capital funding rounds, taking on the primary responsibility for structuring the investment. Acting as the anchor of a deal, the lead investor sets the terms, negotiates valuation and equity ownership, and often secures board seats and protective provisions. Their involvement extends beyond just providing capital. They conduct thorough due diligence, analyzing financials, legal frameworks, and technical feasibility before committing funds. Typically, the lead investor commits the largest portion of the round, often contributing between 20% and 50% of the total funding. This financial commitment serves as a strong signal to other investors, helping attract additional backers by reinforcing the startup's credibility. By leading the round, they not only facilitate capital flow, but also take on a governance role, often securing a board seat to help shape the startup's strategic direction and provide ongoing mentorship. A notable example of a lead investor in action is Sequoia Capital, which, when leading a funding round, sets the valuation, establishes investment terms, and works closely with founders to drive long-term growth. Their involvement extends beyond the initial transaction, actively guiding startups through key inflection points and ensuring they scale effectively. However, taking the lead in an investment round comes with its challenges. A lead investor assumes greater responsibility, requiring extensive due diligence before making a commitment. They also take on heightened financial exposure, meaning the startup's success or failure can significantly impact their returns. This role demands a hands-on approach, ensuring that the company stays on track, executes its business plan, and successfully navigates future funding rounds or potential exits. Despite the risks, many venture capital firms choose to lead deals because it grants them more control over the investment. It allows them to shape the company's growth trajectory, secure a stronger ownership position, and have deeper involvement in critical company decisions. For firms looking to build a concentrated portfolio of high-impact investments, taking the lead is often a strategic advantage that ensures a more significant influence on a startup's long-term success. A follower investor participates in a funding round but does not take the lead in structuring the deal. Instead, they invest under the terms set by the lead investor, a strategy often referred to as piggyback investing. This allows them to rely on the lead's due diligence, valuation assessment, and negotiation efforts without having to engage in the complex process themselves. This approach offers several advantages. Follower investors take on significantly less work and lower risk, as they trust the lead investor's analysis and decision-making. Rather than conducting extensive independent due diligence, they can simply evaluate the deal based on the lead's findings. Additionally, they have flexibility in investment size, allowing them to commit smaller amounts and reduce financial exposure. This flexibility makes it easier for them to diversify across multiple startups, spreading risk rather than concentrating capital in just a few high-stakes investments. Because followers do not take on board seats or governance responsibilities, their involvement is typically passive, allowing them to focus on portfolio strategy rather than operational oversight. A common example of this dynamic is when a major venture firm, such as Andreessen Horowitz, leads a $50 million funding round. Smaller firms, angel investors, or family offices may join the round as followers, investing under the same terms negotiated by the lead investor. Despite its advantages, being a follower also has drawbacks. Because followers do not negotiate terms, they have less influence over valuation, equity allocation, or protective provisions. They are entirely dependent on the lead's judgment, which means that if the lead miscalculates a company's valuation or overlooks critical risks, followers bear the consequences as well. Their access to company strategy is also limited, as they do not hold board seats and may have minimal interaction with the startup's leadership team. Many investors opt to take a follower position rather than lead because it enables them to spread their investments across multiple companies without the responsibility of structuring deals. For firms looking to maintain a broad portfolio while minimizing workload and risk, following can be an effective way to participate in venture capital without taking on the full burden of leadership. The choice between leading or following depends on the VC strategy, fund size, and risk appetite. Let investors write the largest check in the round, take on high due diligence responsibility, and have full control over negotiating valuation and terms. They often take a board seat and face higher risks, but also have bigger potential rewards. This role requires a significant time commitment and deeper involvement with the startup. Follower investors, on the other hand, invest smaller amounts, rely on the lead's due diligence, and have no influence over terms. They rarely take board seats, assume lower risks, and adopt a more passive role. This approach allows them to spread their investments across multiple startups without spending excessive time on each deal. Some VC firms take a hybrid approach, leading early-stage rounds such as seed and Series A, but following in later rounds like Series B, C, and beyond when larger investors step in. In venture capital, the distinction between lead and follower investors shapes the structure of funding rounds. Lead investors take on more responsibility, negotiating terms and actively guiding startups, while followers invest with less risk and effort by relying on the lead's due diligence. For startups, securing a strong lead is crucial, as it not only ensures better deal terms but also attracts additional investors, increasing the likelihood of a successful funding round. Understanding this dynamic helps both investors and founders navigate the venture ecosystem effectively.